If you asked most Iraqi dinar investors what matters most, many would probably answer with two words: the exchange rate. It's understandable. The exchange rate is easy to see, easy to compare, and easy to obsess over. Every movement seems to promise either opportunity or disappointment. But what if that's the wrong place to look? Imagine buying shares in a company. Would you judge its future only by today's stock price while ignoring whether the company is profitable, modernizing its operations, attracting investors, or fixing years of internal problems? Most people wouldn't. They'd want to know whether the business itself was becoming stronger. Countries work much the same way. Behind every currency is an economic system. Behind every exchange rate is a network of banks, payment systems, regulations, government finances, international relationships, and public confidence. If those foundations are weak, changing the number on a currency board rarely creates lasting prosperity. But if those foundations become stronger, something much more important begins to happen. Trust grows. That is why, in Iraq's case, banking reform may matter far more than the exchange rate itself. For years, discussions about the Iraqi dinar have focused on one question: will the value change? Yet policymakers inside Iraq and many international financial institutions have often been focused on an entirely different question. Can Iraq build a financial system capable of supporting a stronger economy? Those are not the same conversation. This difference explains why banking reforms sometimes appear slow, technical, and even boring. New compliance rules, digital payment systems, anti-money laundering measures, banking supervision, international reporting standards. None of these generate dramatic headlines. Yet together they form the invisible infrastructure that allows modern economies to function. History offers an interesting comparison. After World War II, countries like Germany and Japan did not begin their economic recoveries simply because their currencies changed value. They rebuilt institutions. Banks began lending again. Payment systems recovered. Businesses regained access to financing. International confidence slowly returned. The stronger currencies that followed reflected those improvements rather than creating them. The same pattern has repeated in many emerging economies over the past several decades. Investors often notice the exchange rate first. Economists usually examine the institutions underneath. Iraq faces its own version of this challenge. For decades, wars, sanctions, political instability, and heavy dependence on oil revenues limited the development of its financial sector. Cash dominated daily transactions. Large portions of the economy operated outside formal banking channels. Many citizens viewed banks with caution, preferring physical cash over electronic accounts. Changing public habits is difficult. But changing an entire banking system is even harder. And yet, over the past several years, Iraq has quietly begun pursuing reforms that receive far less attention than exchange rate speculation, but may ultimately prove far more significant. Because once a country begins rebuilding trust inside its banking system, it often sets in motion changes that extend far beyond banks themselves. And that's where the story becomes much bigger than currency alone. To understand why these reforms matter, it helps to think about what a modern banking system actually does. Most people see banks as places to store money or apply for loans. In reality, they are the circulatory system of an economy. Just as blood carries oxygen throughout the human body, banks move capital to businesses, households, and governments. When that circulation slows or becomes unreliable, economic growth begins to suffer. For many years, Iraq's financial system faced exactly that challenge. A large share of transactions happened in cash, limiting transparency and making it harder for businesses to build reliable credit histories. Small and medium-sized enterprises, the businesses that often create the most jobs in developing economies, struggled to access financing because banks had limited information to evaluate risk. Instead of capital flowing efficiently into productive investment, much of the economy remained dependent on cash and oil revenues. This is where recent banking reforms begin to change the picture. One of the most significant shifts has been the push toward digital payments. Encouraging salaries, government transfers, retail purchases, and utility payments to move through electronic channels does far more than make transactions faster. It creates financial records. Those records allow banks to better assess borrowers, reduce fraud, improve tax collection, and expand access to financial services. In other words, digital payments are not just a technological upgrade, they create the data that modern banking depends on. Another major focus has been strengthening anti-money laundering and counter-terrorism financing standards. At first glance, these regulations can appear burdensome, but they serve a much larger purpose. International banks and investors are far more willing to work with countries whose financial systems meet globally recognized compliance standards. Without that trust, cross-border payments become slower, more expensive, and sometimes impossible. Compliance, therefore, is not simply about regulation. It is about opening doors to the global financial system. A good historical comparison is the transformation of the Gulf states over the past few decades. Countries such as the United Arab Emirates invested heavily in modern banking regulations, payment infrastructure, and international financial standards. Those reforms helped attract foreign businesses, multinational banks, and global investment. Not because their currencies suddenly became stronger overnight, but because investors trusted the institutions behind them. Iraq is attempting a similar journey, although under very different political and economic circumstances. The Central Bank of Iraq has introduced measures aimed at strengthening banking supervision, encouraging electronic payments, modernizing financial infrastructure, and improving transparency. These efforts are designed to make Iraq's banking sector more resilient and better connected to international financial markets. This also explains why exchange rate discussions can sometimes be misleading. A stronger currency without credible institutions may provide only temporary confidence. But stronger institutions can gradually support sustainable economic growth, attract investment, and increase confidence over many years. In that sense, the banking system is not following the economy, it is helping to shape its future. Yet an even bigger question remains. Even if Iraq succeeds in modernizing its banks, could that transformation reshape the country's entire role in the regional and global economy? That possibility takes the story beyond finance and into geopolitics, and that's where the final chapter begins. A modern banking system does not exist in isolation. It influences trade, investment, entrepreneurship, government finances, and even diplomacy. When banks become more efficient and internationally trusted, they make it easier for businesses to import machinery, exporters to receive payments, foreign companies to invest, and governments to finance long-term development. In many ways, banking reform becomes a bridge between domestic policy and the global economy. Iraq has ambitions that extend well beyond rebuilding its financial sector. The country is working to diversify its economy, reduce dependence on oil revenues, expand non-oil industries, improve customs administration, modernize logistics, and strengthen regional trade connections through projects such as the Development Road Initiative. None of these goals can reach their full potential without a banking system capable of supporting large-scale commerce and international finance. Consider what happens when a foreign manufacturer evaluates whether to build a factory in Iraq. The first questions are rarely about the exchange rate alone. Investors want to know whether they can transfer funds securely, obtain financing, pay suppliers efficiently, insure their investments, and operate within a predictable financial system. A modern banking sector reduces uncertainty, and reducing uncertainty is often one of the strongest incentives for long-term investment. There's another misconception worth challenging. Some people assume that if Iraq completes enough banking reforms, a dramatic currency event must automatically follow. In reality, economics is rarely that simple. Banking reform is one important piece of a much larger puzzle that also includes fiscal discipline, political stability, economic diversification, inflation control, foreign investment, legal certainty, and confidence in public institutions. These factors influence one another, and no single reform guarantees a specific exchange rate outcome. History reinforces this lesson. Countries such as South Korea and Singapore did not become economic success stories because their currencies suddenly appreciated first. Their currencies gained credibility over time because productive economies, reliable institutions, and internationally respected financial systems had already been built. The strength of the currency reflected the strength of the system, not the other way around. That perspective changes how we interpret Iraq's progress today. Instead of asking only, has the exchange rate changed? A more revealing question might be, is Iraq becoming a country where businesses, investors, and international financial institutions have greater confidence year after year? If the answer gradually becomes yes, then many other economic improvements become more achievable, even if they take time. This doesn't mean the journey is guaranteed. Iraq still faces significant challenges, including political disagreements, regional tensions, dependence on oil revenues, governance reforms, and the practical difficulty of transforming a financial culture that relied heavily on cash for decades. Progress is rarely linear. Some reforms move quickly, while others face delays or require years before their full impact becomes visible. But perhaps that's the biggest lesson of all. Exchange rates are highly visible, so they naturally capture attention. Banking reforms are mostly invisible, unfolding through regulations, technology upgrades, compliance standards, and institutional improvements. Yet history repeatedly shows that these quieter changes are often the ones that reshape economies over the long run. So the next time headlines focus entirely on the Iraqi dinar's exchange rate, it may be worth looking one layer deeper. The more important story may not be the number printed on a currency board, but the institutions being built behind it. Because in the end, currencies don't create strong economies. Strong economies, and the trusted banking systems that support them, are what give currencies lasting value. If you enjoy thoughtful analysis that goes beyond the headlines, consider subscribing. We'll continue exploring the economic, geopolitical, and financial developments shaping Iraq and the wider global economy.